this year has been a tale of two markets. Through July, it was risk on. Why? Because the market was seeing surprises in terms of oil prices coming down, auto prices coming down, and saying, oh, the Fed must surely be done. And then we get a CPI print or a PCE print that disappoints, and the Fed continuing to say, oh, no. Well, higher for longer, and we absolutely will raise interest rates if we cannot see 2% inflation. So I think they're in the process of making a mistake.
In today's update, we bring you the most recent interview with Cathie Wood, the CEO of Ark Invest, offering insights into the market and projections for 2024. Across the United States, the impact of Federal Reserve policymakers' interest rate hikes is palpable. Officials exercise caution in signaling an end to their efforts to combat persistent inflation, drawing lessons from the 1970s when premature easing led to a resurgence of double-digit price increases. Despite the Federal Reserve Bank of San Francisco emphasizing that claiming victory over inflation is premature, investors speculate on whether the upcoming Fed meeting's rate cuts will signify the conclusion of the current credit tightening cycle. This speculation has boosted stock and bond prices, reflecting market confidence in the Federal Reserve's intentions. Delve into our latest interview with Cathie Wood as she discusses her outlook for 2024. Wood sheds light on anticipated economic indicators, addressing topics such as inflation, the stock market, and the potential influence of cryptocurrencies on the global monetary system.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
We're getting more proof of concept on deflation too. So it starts at the commodity level, always does, right? Copper prices peaked at $5. They're now about $3.50. Oil even, is down to, well, it's in the 70s, but even more interesting to us is gasoline is pointing to much lower oil prices. The demand destruction in gasoline right now, because of the pricing, is so high. I think gasoline demand, was it around the Labor Day holiday, hadn't been this low in 25 years, something like that. Big demand destruction in all kinds of categories, including staples. Now, the Procter & Gamble's and staples companies, they took full advantage of supply chain crisis and jacked prices up. Guess what? Their volumes are falling. That is not a good recipe for a manufacturing company. You want to keep your manufacturing plants running full time. And now they're seeing a pullback in unit volume. We're seeing in the S&P 500, about a third of the S&P 500, a third of the companies are showing falling revenues. Falling revenues. That means the combination of units and pricing, that combination is down. If you look at commodity prices as measured by the Bloomberg Commodity Price Index, they are today where they were in the early 80s. They've gone nowhere.
Well,
M2 growth has been negative all this year on a year-over-year basis. The yield curve has been inverted all year, actually almost a year and a half now, roughly a year and a half
but no
now.
recession yet.
Rolling recession. Housing, by some measure. Sales, down 40%. That's a recession there. Auto sales, 15 million units. That's recessionary. Falling prices as units fall, that sounds recessionary. And that's happening in staples. Home Depot today, sure, it was one of the biggest beneficiaries, but it's been 2 to 3 years now, and it's still saying minus 3% same-store sales growth. That's both price and profits, and deeper negative here in the US, minus 3.8. So I'm looking at statistics and I'm listening to earnings calls. When I listen to earnings calls, and I listen not just to ours, but to other more cyclical companies, just to get a sense of the economy. You listen to them and you'd think we're in a recession. Now, it depends on the area. We're in today's CPI, you saw auto prices coming down, you saw airline prices coming down, so you saw education prices coming down, oil and energy transportation we knew about. Rents, the pop last month reversed, didn't go negative, but in the real world, we're hearing about serious rent declines. or serious discounts like 6 months free or 1 month or 1 year free. So I think it's all around us. The Fed is paying attention to lagging indicators. One is the CPI. It's gone from 9 to now roughly 3. We think it's going to turn negative before all is said and done. The other one is employment. Now, what the heck is going on in employment if what I just told you is true?
Right.
We know how many companies had such trouble finding anyone as we were coming out of COVID. They're reluctant to fire people even though their margins are starting to fall, so they don't want to go through that again.
Cathie emphasizes that in certain nations, there is a reluctance to rely on politicians for decisions regarding monetary policy. Emerging markets are increasingly turning to digital currency, and Cathie contends that, given the prevailing market outlook, decentralized finance is poised to assume dominance, supplanting the functions of many financial services companies. In this transformed landscape, these entities will be positioned to provide lower rates to savers while offering higher rates to borrowers.
Well, M2 growth has been negative all this year on a year-over-year basis. The yield curve has been inverted all year, actually almost a year and a half now, roughly a year and a half
now. But no recession yet.
Rolling recession. Housing, by some measure. Sales, down 40%. That's a recession there. Auto sales, 15 million units. That's recessionary. Falling prices as units fall, that sounds recessionary. And that's happening in staples. Home Depot today, sure, it was one of the biggest beneficiaries, but it's been 2 to 3 years now, and it's still saying minus 3% same-store sales growth. That's both price and profits, and deeper negative here in the US, minus 3.8. This year has been a tale of two markets. Through July, it was risk on. Why? Because the market was seeing surprises in terms of oil prices coming down, auto prices coming down, and saying, oh, the Fed must surely be done. And then we get a CPI print or a PCE print that disappoints, and the Fed continuing to say, oh, no. Well, higher for longer, and we absolutely will raise interest rates if we cannot see 2% inflation. So I think they're in the process of making a mistake. But in the beginning of the year, people were saying, okay, the numbers are coming down, inflation's, doing what it should do. Then we had this pause where, are we stuck here at 3 to 4%? Many people think we are because they see these wage hikes going through, 10% per year, 6% per year. And they say, surely we're back in a 70s style inflation. And that, that's what the Stanley Druckenmillers and the bears out there are thinking. We think that is absolutely wrong, that the resolution of that 10% push in wages per year will end up in lower margins. Big problem, not in higher prices. Big difference, very big difference. And so I think it's from the end of July through, really it was through the end of October, we went through this big nervous period where the long bond yield started rising relative to the short-term yields. Still an inverted yield curve, but long yields were rising. It was a bear flattening, not a bull flattening. A bull flattening is when short rates come down relative to long rates. So a bear flattening went risk off. People sold our strategy. Sold anything risk off and moved back to their benchmarks, moved into cash, huge amounts of cash on the sidelines. Now we're getting more prints again that are saying the Fed probably has overdone it. And you just listen to quarterly company calls and you'll listen to these management teams, and we have lots of callbacks with managements, and they say, why are you the only one seeing recession? Why can't the Fed see this? This is what we're going through, just on the expectation of rates going up. And then on the reality of rates going up, we were crushed in 2022. The market has discounted what the Fed has done. I don't think the Fed's going any further. If the market can feel comfortable that that is indeed the case, we don't have to have rates even come down. We think they will. But we think that certainly our strategy has discounted the worst. I don't think value stocks have discounted the worst of the cyclical part of the recession. We tend to be recession resistant. The last leg here is going to be consumption. And we'll see how the holidays fare, how deal-driven consumers are. We think they're really deal-driven.
Cathie Wood highlights the movement in crypto legislation within the House, indicating a growing interest in the crypto space. While potential challenges may arise due to opposition from certain figures, Cathie is optimistic that the ongoing conversation alone will benefit the crypto market, creating opportunities for potential growth. She also delves into the current monetary policy, expressing Chairman Powell's characterization of it as restrictive, which raises concerns about inflation rates. The potential uptick in real interest rates could influence investment decisions, making alternative assets like Bitcoin and other cryptocurrencies more appealing due to their inflation-resistant properties. Share your thoughts on Cathie Wood's latest interview and her insights on government debt, rapid economic growth, and the continually evolving landscape of cryptocurrency by commenting below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.